Welcome back. This is a continuation of our topic, financial securities. So let's just simply dive in. However, let's do a quick recap. In our previous topic, we were discussing on type of financial securities, and we listed them to be common stocks, bonds, hybrids, and derivatives. And we listed some of the hybrids to include preference share, financial lease, participating bonds, convertible bonds, and detachable bonds. And we have already explained preference share, financial lease, and participating bonds in part 1 of this class. Now let's discuss the other two, convertible bonds and detachable bonds. But before we do so, let us talk about warrants. What are warrants? And why are we digressing to discuss about warrants? We are not really digressing at all. It is to make our discussion clearer. So what are warrants? Warrants, they are securities that are issued by a company that gives the holder of those security a right, that is an ability to buy stock at a specific price before the expiration date. Too much grammar. Let's break it down. I say warrant is a security that is issued by the company to the holder, telling the holder that he has the option, he has the ability to use this warrant to buy shares in their company at a future date at a specific price if he so wishes. That means you can use that warrant to buy ordinary shares in the company before the expiration date of that warrant and at a specific price, and that specific price is known as the exercise price. I know you'll be saying, this sounds almost like option. The difference between warrants and option is that warrant is issued by the company, but options are issued by another trader. Warrant, it gives the holder the right to purchase a certain numbers of ordinary shares over a specific period of time before the expiration of the warrant, which means warrant comes with what? A specific price. That is called the exercise price. And it comes with what? An expiration date. And if you choose to buy those shares, it means you have what? You have exercised your rights. What we are saying here is that warrant gives you the right to exchange your financial instrument for ordinary shares. Like I said, it gives you a right. You are not obligated to do so if you feel it is not the right time for you to do so. But if you must exchange it, you must do it before the expiration date. One of the beautiful things about warrants is that it gives you that flexibility to exercise or not to exercise, and when to exercise and when not to exercise. Warrants can also be attached to debt instruments to make them more attractive to investors and obviously more cheaper for the issuer. Because not only does it lower interest rate, it also has fewer restrictive covenants. And it's also a form of raising capital for the issuer, as it is used to sweeten the deal and attract investors. Warrants can even be used to compensate managers. So we can see that a warrant is giving you that opportunity to become an owner in the future before the warrant expires. And if you exercise the warrant, it means you have become what? A shareholder. That is an owner in the business, in the firm. And by buying those stocks, it means you have increased the numbers of stock in the firm. You have just diluted their shares because the company now has more owners. Let's create a scenario. Let's assume you buy a warrant for 2 naira. And on the warrant, you are told that you can exercise the warrant for 25 naira at any time within the next 2 years at 1 warrant for 1 ordinary share. Now you waited for a couple of months and you find out that the market price for these shares have risen to 35 naira per share. This means we have made a gain of 10 naira. That is 35 naira, the correct market value, minus 25 naira our excise price. And this gain is called the intrinsic value. So if we minus this 10 naira from how much we bought it, which is just a warrant price of 2 naira, we have just made a huge profit of 8 naira per stock. No be juju be this. Just imagine people are buying stock today for 35 naira per share, and we are buying it at 25 naira per share at the excise price. We were wise enough to buy that warrant at 2 naira per stock.
That is.
We were wise enough to buy that warrant at the earlier date. Let me create a different scenario. Let's assume that the current market price is 25 naira per share. There is no profit here because our excise price is also 25 naira, which means we made zero profit. We didn't even make zero profit. We made a loss because we bought the warrant for 2 naira. So we have even shorting 2 naira. So what did we learn here? What we learned here is that we should only exercise our warrant if the market price is greater than the exercise price, or else na sorry go be your name. Because this market is a very volatile market. You can enjoy great profits and also suffer great losses. So if you are going into this type of instrument, you need to study the market spread very, very well. Warrant act as a leverage. Why did I say so? It's because it allows us to use a very small amount of our money to control a large investment with the aim of making profit. That is, warrant helps us to amplify our profits. But sadly, if you are not careful, it can also amplify your losses if we don't play it right. When I say warrant is a leverage, I mean that it allows the investor to control a large position in the company's stock with a relatively small amount of money, because that warrant gives you the right to buy shares at a fixed price, that is the excise price, instead of buying it outright at the current market price, which may be higher. This means that we are now controlling the same numbers of shares but with less capital. And because our initial cost that we invested in the warrant is low, our return can be very huge. Next, we have detachable securities. As the name implies, these are the securities that can be detached from one another. That is, they can be separated and sold independently in the market. When a company issues preference share or a bond, it may decide to attach an extra benefit like a warrant to it to make it more attractive to investors, even at its lower interest rate. And we call such a security a detachable security because the warrant can be removed. It can be detached from the preference share or detached from the bond and sold separately. With a detachable bond, the bond still pays interest like a normal bond. And the warrant also gives the holder the right to buy shares later at a fixed price. Let me create a scenario. Let's say the company issues a bond at 10,000 naira. And the bond comes with a warrant of 2,000 naira, making it a total of 12,000 detachable bond. You can decide to separate the bond of 10,000 naira from the warrant of 2,000 naira and sell them separately, or you can decide to sell them together. Now let's move on to convertible securities. As the name implies, they are securities that can be converted from one form to ordinary shares, that is to stocks. That is, they are either preference shares or bonds that have convertible futures that can be converted to ordinary shares. Whatever the case may be, maybe they are convertible preference share or convertible bonds. The most important thing here is that the conversion futures, it gives the security the ability to convert, that is to change from its original form into common stock. Convertible security gives the holder of the security the opportunity to convert from being a bondholder to being a shareholder. So let's understand that convertible securities, they are just straight preference shares or straight bonds with conversion futures. Meaning that if that bond or preference share is not a convertible preference share or a convertible bond, then we can describe them as a straight preference share or a straight bond. You may ask, how is convertible securities different from detachable securities? Because from where we are standing, it seems to be the same thing, as both of them give the security the opportunity to change to ordinary shares at a specific price during a specific period of time. The main difference between a convertible security and a detachable security is that the detachable security can be separated. That is, the bond can be separated from the warrant. But in the case of convertible security, the conversion futures cannot be separated from the bond. Another difference is that after exercise in a debenture, both the bond and the warrant, they remains the same. But in convertible securities, the original form of that security disappears. Detachable security are more volatile and highly flexible than convertible securities. So why do companies issue convertible securities? Because it gives the holder the right to sell the security for ordinary shares in the future before its maturity date. And it is attractive to investors who may not initially want equity. That means it enhances the marketability of the security as it combines the benefits of both a debt and an equity. It is a very cheap form of security because it is issued at a lower interest rate. And one of the beautiful things is that it does not come with risk associated with raising new capital, as it simply converts existing capital from one form to the other. So we can see that convertible securities, they can be converted at any time before the maturity of the bond or after a set period of time in the case of preferred shares. At the time of issue, the face value of the bond is usually stated there. That is the amount we use in buying that bond. The rate of conversion is also stated at the time of issue.
This rate of conversion is also called the conversion price.
What I mean is that it can state that for a bond of 1,000 naira, the conversion price is 40 naira, or the conversion rate is 40 naira, same thing. Meaning that our conversion ratio is simply 1,000 naira divided by what? The conversion price of 40 naira, which gives you what? 25 shares. It means that if we decide to convert our bonds to shares, we would get 25 shares. Or at the time of issue, it can be simply stated there that we will get 25 shares for 1,000 naira bond. Or that 40 units of bond will give us what? 25 shares. It all means the same thing. It is just worded differently. Normally, the conversion price is usually lower than the market price at the time of issue. That is what makes it attractive. And we hope that the market price will even be higher at the time of conversion. So let's assume that at the time of conversion, the market price is 45 naira. This means that the value we get from converting 25 shares at 45 naira current market price is 1,125. And this is the conversion value.
And when we compare
the conversion value with the amount we use in buying that bond initially, we have made a gain of 125 naira. But I hope we realize that conversion value is conversion ratio multiplied by current market price. Let's solve the problem before us. Reading through this question, we can see that Sun and Fon sport equipments are in need of capital of $1 million, and they are deciding should they finance their capital needs with common stocks, knowing that the current price of common stock is $40 per share, or should they finance this project with convertible bonds? This is a question of common stock versus convertible bonds. Which should we use to obtain our $1 million capital? And going down, we can see that the firm already has 250,000 common shares. That is, their existing shares is 250,000. And it is stating that if they so choose to raise their capital by convertible bonds, they are going to issue it at 1,000 naira. That is 1,000 naira par value at a conversion price of $45. Scrolling down, we can see that earnings available to be shared to shareholders is $700,000 each year. Now, what are we asked to do? A, we are asked to calculate the numbers of shares the firm would need to sell to raise $1 million. So the amount of capital needed is $1 million. And we know that the market price per share is $40, meaning that the numbers of new shares you have to issue to get $1 million is what? 25,000 shares. So that answers question A. The firm will need to raise 25,000 shares to get a capital of what? $1 million. Now let's go to question B. It says calculate earning per share as a result of the sale of common
shares.
It is asking us to calculate EPS after we have issued new shares. After we have issued these new shares of 25,000, what is the current EPS? And we know that to calculate earning per share is simply what? Total earnings divided by total numbers of ordinary shares. And the total earnings is given to us in the question as $700,000. And our total numbers of shares after issuing new shares is what? Our existing shares of 250,000 plus our new shares of 25,000, making a total shares of 275,000. Therefore, our EPS is earnings over numbers of ordinary shares, which is 700,000 divided by 275,000. It will give us $2.55. Sorry, we are talking in dollars, not in naira. So $2.55 is the current earnings shareholders will now receive per share. Now let's move on to question C. Calculate the numbers of shares outstanding once all bonds have been converted. Now we are assuming we did not take the option of issuing new shares, that we want to take the options of buying convertible bonds. And how much capital does the firm need to raise? They need $1 million. And we were told that convertible bonds can be sold at $1,000 per bond, meaning that to get $1 million, we need 1,000 bonds. So how many shares can we get for 1,000 bonds when we choose to convert to ordinary shares? We remember the
Question
told us that the conversion rate, the conversion price is $45. This means that for 1,000 bonds, we are going to get 22.22 shares, meaning that our total numbers of new shares after conversion will be numbers of bonds times price
per share
multiplied by numbers of shares per bond. Meaning after conversion, we are going to get a total of 22,222 shares. And if we add these 22,222 shares to our existing shares before conversion of 250,000, it will bring the total shares after conversion to 272,222. And this brings us to question D. It's asking us to calculate the earnings per share associated with bond financing after conversion. And we know that to calculate EPS is simply total earnings all over total numbers of ordinary shares. Total earnings in the question remained $700,000. And total numbers of shares after conversion is 272,222. This makes our earnings per share $2.57. Now this moves us to question E. It says, which of the financing alternative will you recommend the company to adopt and why? We can see that when we issued ordinary shares, earning per shares was $2.55. But when we issue convertible debentures, earning per share was $2.57. So we can see that conversion gave us a higher earning per share. Also, when we issued ordinary shares, our total numbers of ordinary shares now moved from 250,000 to 275,000. But when we issued debentures, it moved from 250,000 to 272,222, which means convertible debenture did not dilute ownership as more as issuing of new shares. On that note, I will recommend we issue convertible debentures. Now, let's move on to derivative securities. As the name implies, they are products that derive their value from something else. Derivative is something that derives its value from something else. This means that derivative is not a product itself. It is more like a contract that derives its value from an underlying asset. That is, it derives its value from changes in prices of the underlying assets. By derivative, you are not buying anything. You are betting on a contract that can pay you big if they work out. That means to say derivative can be used for speculation and even for gambling, because here we are playing with risk in order to make a huge profit. Here we are using arbitrage. That is taking advantage of short-term price abnormalities in the market, meaning that it is very flexible to use. And because we are playing with risk, it is used to hedge. That is, it is used to reduce risk. Like a manager who doesn't want to miss out on dividends, but is worried about the market price of his shares, he can decide to use an option as a safety net. What is this telling you? This is telling you that options is a type of derivative security. I know we have discussed on real options in our previous class as it relates to tangible assets. But right now, I am talking about options as it relates to securities. That is, as it relates to intangible assets. So what is an option? An option is a financial instrument that gives the holder a right to buy or sell securities at a specific price on or before the expiration date of that instrument. That specific price that the option holder can buy or sell the option is known as the strike price. And the option holder can buy or sell that option at that strike price at any time before the option's maturity date or expiration date. So we can see that options give the holder a choice or a flexibility in how and when to buy and sell the security for a gain, for a premium. If the option gives you a right to buy, it is called a call option. It is coined from the phrase call it up. That is, you should buy when the prices go up. And when the option gives you a right to sell, it is also called a put option, coined from the word put it down, because prices has gone down. When an investor purchases a call option, they do so in anticipation that the price of the underlying asset will increase in the nearest future. But if the market price then falls below the strike price, the option holder will have to exercise this option and sell at the strike price. The option price is usually negotiated between the buyer and the seller, unlike the warrant price that is given to us by the issuer. Assuming we bought an option for 100 naira, and this 100 naira option gives us a right to purchase 100 shares of the underlying assets at a strike price of 45 naira. Now, assuming that the current market price is 50 naira, it means we have made a gain of 5 naira. That is the market price minus the strike price. We have made a gain of 5 naira per share. And if we want to calculate our total gain for 100 shares, it is what? 500 naira. So if you deduct the 100 naira that we use in purchasing the initial option, we have made a net gain of 400 naira. So why do we buy and sell options? It allows investors to gain from the benefit from changes in market price. It helps the investor to lock down a good price today for shares you may get in the future. That is a strike price. This means that call option helps to protect current position. Options can also be grouped into two: the American options and the European options. The American options are very flexible options. This type of option can be exercised at any time from the date of purchase up to the expiration date. It is a more expensive type of option and it gives the holder higher premium, while the European option is more restrictive. Here you must wait till the expiration date before you can exercise your option.